Did you know that over 80% of new investors lose money within their first year? Not because the stock market is broken, but because they didn't have a strategy. They jumped in too fast, followed hype, and made emotional decisions that cost them thousands. That said, investing is not complicated. You can build real wealth using simple, proven strategies that actually work, even if you're just starting out. In this video, I'll break down the smartest investment strategies for beginners step by step, so you can avoid mistakes most people make and start building your wealth with confidence. This is important because investing is one of the most powerful tools to achieve financial freedom, but it's also one of the most misunderstood. Every day, you hear conflicting advice. Buy crypto. No, invest in real estate. Oh, wait, index funds are the only way. The truth is, there isn't one magic formula, but there are timeless strategies that have consistently worked for millions of investors. So this video will help you discover how to start investing the smart way, how to manage risk, and how to grow your money steadily over time. Whether you want to invest in stocks, real estate, or ETFs, this video will help you build a solid foundation to get started the right way. So grab a notebook, because by the end of this video, you'll know exactly how to make your first investment confidently and strategically. But first, let's take a look at why most beginners fail. Here's the harsh reality. Most beginner investors fail, not because they lack money, but because they lack direction. Let's look at a few common mistakes. 1. Following the hype. Remember the 2021 GameStop and AMC stock craze? Millions of new investors jumped in, hoping to get rich quickly. Some made fast money, but most bought at the top and lost big when prices crashed. 2. Emotional investing. When the market dips, panic sets in and they sell everything at a loss. Or it spikes and they buy out of FOMO, the fear of missing out. 3. No clear plan. Many beginners invest randomly without understanding their goals, risk tolerance, or time horizon. These mistakes can cost you thousands and years of progress. So the key is this. Smart investing isn't about timing the market. It's about staying in the market long enough for your money to grow. That's the difference between beginners who lose momentum and those who quietly build wealth year after year. With that in mind, let's break down the smart investment strategies that actually work and have been proven by data, not hype. 1. Dollar cost averaging, or DCA. Dollar cost averaging means investing a fixed amount of money at regular intervals. For example, $100 every month, no matter what the market is doing. Instead of trying to guess the perfect time to buy, you buy consistently. Why this works? When prices are high, your $100 buys fewer shares. When prices are low, it buys more shares. Over time, this averages out your cost and reduces your risk. Here's a real-world example. If you invested $200 per month into an S&P 500 index fund over the past 10 years, including during crashes like 2020, you'd still have nearly doubled your money today. That's because consistent investing beats emotional guessing every single time. 2. Index fund investing. Index funds are one of the smartest investments for beginners. An index fund is basically a basket that holds tiny pieces of hundreds of companies. For example, an S&P 500 index fund gives you ownership in giants like Apple, Microsoft, and Amazon all at once. Why this works? It's automatically diversified. It's low cost, no expensive fund manager taking huge fees. And historically, it outperforms most active investors. Even Warren Buffett, one of the greatest investors of all time, recommends index funds for most people. In fact, Buffett once bet a group of hedge fund managers that an index fund would outperform them over 10 years. The result? The index fund won by a mile, yielding an astonishing 125.8%, while the hedge funds lagged far behind, delivering from a tiny 2.8% to 87.7%. If you're just starting out, investing in index funds through apps like Vanguard, Fidelity, or Charles Schwab is a simple, low-stress way to grow wealth. 3. Diversification. Here's one of the golden rules of investing. Never put all your eggs in one basket. Diversification means spreading your investments across different asset classes, like stocks, bonds, and real estate. so that if one part of your portfolio drops, the others can balance it out. For example, if you invested only in tech stocks in 2022, you have seen massive losses when the tech sector crashed. But if you also had bonds or real estate funds, those could have helped cushion the blow. Diversification doesn't eliminate risk, but it manages it. And that's the difference between panic selling and sleeping well at night. 4. Build an emergency fund before you invest. This might sound boring, but it's absolutely essential. Before you put a single dollar into the market, make sure you have 3 to 6 months of living expenses saved in cash or a high-yield savings account. Why? Because life happens. Cars break down. Jobs are lost. Medical bills appear. If you don't have emergency savings, you'll be forced to pull money out of your investments at the worst possible time, during a market dip. For example, during the 2020 COVID crash, millions of investors had to sell their stocks for cash, locking in huge losses. Those with emergency funds didn't have to sell, and they watched their portfolios recover and grow. Think of your emergency fund as your financial seatbelt. It keeps you safe when things get rough. 5. Focus on long-term growth. This is where most new investors fail. They think investing is a sprint. It's not. It's a marathon. Markets go up and down daily, but over time, they've always grown. For example, if you invested $10,000 in the S&P 500 in 1993 and never touched it, you have more than $100,000 today, even after multiple recessions and market crashes. The key? You didn't sell when things got scary. Patience and discipline are your biggest advantages as an investor. So instead of checking your portfolio every day, focus on time in the market, not time in the market. And here's one thing that most people overlook. You don't need to be a genius to succeed in investing. You just need a system. Invest consistently. Keep costs low. Diversify. And be patient. That's it. Even if you only invest $100 a month starting in your 20s, compound interest can turn that into hundreds of thousands by retirement. Albert Einstein called compound interest the 8th wonder of the world. And he wasn't kidding, because money that earns money and then earns more money grows exponentially over time. That's the real secret of smart investing. Let's quickly recap the 5 smart investment strategies for beginners that really work. Start with an emergency fund. Use dollar cost averaging. Invest in low-cost index funds. Diversify your portfolio. And focus on long-term growth and patience. You don't need fancy stock-picking skills or insider knowledge. You just need consistency and discipline. Remember, wealth isn't built overnight. It's built quietly over time by people who plan and stay on course. If you found this video helpful, let me know in the comments. Also, let me know your biggest challenge or fear when it comes to investing. I check every comment, and I might feature your question in another video. Until next time, remember, start smart, stay consistent, and build your wealth. Thanks for watching.